Joining us now to break down this inflation print, we've got Brian Jacobsen, the chief economist and strategist at Annex Wealth Management, and Kathy Bostjancic, who is the Nationwide's chief economist and senior vice president. Great to have you both here with us. Just as we're looking through this print here, Kathy, I want to begin with you. Just your takeaway from an economic perspective and your reading through this CPI print.
Well, thank you, Brad. I mean, well, first off, these are positive readings and a welcome relief, right? We've particularly the core reading up just 0.2, because we're coming off, many months in a row where we've seen, firmer 0.3 increases. So this is very welcomed. It does allow the year-on-year rate to decline. Looking through some of the details, what's also very encouraging, owner's equivalent rent, you mentioned shelter. The owner's equivalent rent is a big share of that, was up just 0.3. So we're continuing to see rather tame increases there, which is really important, such a large share of core CPI. But what also caught my attention is the motor vehicle prices were down on the month. That also helps lower pressure on the core. And as you mentioned, gasoline prices were down sharply. We also saw transportation services because airfares were down. These are things that may reverse. We know going forward, airlines are struggling. They may try to pass on higher prices. And also looming in, on top of all of this is the tariff uncertainty. And as we go forward, like today, the aluminum steel tariffs go into place. That's going to put upward pressure on motor vehicle prices and used car. So that could change this picture. But as of February, this is a good print.
So Brian, talk to me about the market reaction. We're obviously seeing stocks surging off the back of this CPI print, but that's interesting to me given that the year-over-year increase here still showed 3.1%. That doesn't start with the Fed's desired inflation rate of 2%. Is this the market showing us that they are ready to get in on this dip, that we have hit the bottom, that we're going to continue to see this dip buying throughout today, or do you think this is just initial euphoria?
Yeah, well, I certainly hope that it means that people are willing to buy the dip on this type of report, but we have to see whether or not that's going to switch to a lot of trepidation. A lot is going to really depend upon whatever comes out of the White House in terms of how things are being negotiated. I mean, this data report itself, I think it really just says that the Fed doesn't have to right now feel like it needs to hike rates. It almost takes that off of the table. I do find that reassuring to think that they're going to be on a pause and maybe inclined to cutting rates, not cutting rates necessarily because they have to in order to stem some sort of drawdown in the economy, but because they can, because inflation is re-engaging towards its 2% target. A lot will depend upon that pass-through from tariffs that are going to be absorbed by importers, then it filters its way through the supply chain, ultimately onto the consumer. And so there's lots of different moving pieces as far as where these tariffs could actually affect inflation and what the Fed will take notice of. But I think that this report itself says that at least the economic slowdown that we saw in January isn't feeding through at the same time into higher prices, which would be that dreaded stagflationary scenario.
Right, and it's not just the tariffs that we're imposing on other countries, but the retaliatory tariffs that we receive back as well. And so, Kathy, with that in mind, what are the indexes that you would be watching most closely to then get a sense of how the Fed would have to be reactionary in their data dependency because of clear elements or areas where there are some price fluctuations that consumers then have to outlast as well?
Yeah, I mean, we're watching squarely the goods sector. So, core goods, I would strip out food and energy and look at those core goods sectors, because that's where the increased tariffs are going to hit. And what we've actually seen, even though February was a good print, and I'm looking at the core goods number, it was a positive reading here, encouraging, but the year-on-year rate has become less deflationary. If you looked back at the August of last year, it was deeply deflationary year-on-year, almost down 2%. Now we're about flat. It's barely in deflationary territory. And so what that means is you don't have a lot of cushion there on the goods sector. If these tariffs start to hit, you see higher motor vehicle prices, other, appliances, construction costs. If all of that starts to go up, you'll see it foremost in the goods sector. And again, that's what we're alert to and trying to estimate and get ahead of. It is tough because sometimes, we've got stop and go on the tariff policy, but it does look like the aluminum steel increases, that's likely to stay in place. Previous administrations have done that. The big question is what happens on April 2nd with the evaluation of reciprocal tariffs. That really is very important.
And Brian, I just want to end with you because we have not seen the full impact of tariffs from the Trump administration on this inflation number because this is from the past month. So we won't get to see a sense of that until next month's CPI print. Just how sticky do you think the good news from the CPI print today will be once we do get that latest CPI data next month, and that does include the totality of the impact of those Trump tariffs?
Yeah, in a way, good news on the CPI might actually be bad news for the markets when we get into March, mainly because if tariff increases aren't showing up in consumer prices, it means that it's being eaten into the profits of businesses or it's being pushed back onto the exporters. And so in a weird way, good news on CPI could actually be bad news on profit margins because they're not able to pass through that. And I would point to, food prices, we'll probably see it there a little bit more in terms of the pass-through. Energy prices as well. We get a lot of crude oil from Canada. And so it will, the month of the March data that we get, which unfortunately won't come until April, is I think we're still stuck in this holding pattern to find out what is the actual effect of these tariffs and who's going to really pay the price.
Brian and Kathy, thanks so much for taking the time here with us this morning to break down the CPI print for the month of February. Really appreciate it.